Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good day, everyone. Welcome to the show today. It's a Q&A day. If you tune in to the Smart Property Investment Show, you know we like to try and do this every sort of month or so. We get a whole bunch of questions coming in from all the different podcasts that we do, and we try and get through all of them when we do these particular shows. To help me out today to answer these, back in the studio, last time we did a Q&A with him was the 26th of March, and you might have heard him recently a week or so ago when myself and him spoke around negativity in the property markets at the moment and how you can go about making sure that you're making the right investment decisions. Simon Pressley, Head of Research, Propertyology, welcome back. How you going, mate?
Fantastic, Phil.
Q&As. So we did a pretty good job on this last time, 26th of March, when we got together. And this is completely off the cuff. We've just been given some questions here, and we just gave them a real quick read, but don't know how we're going to answer them yet, and I'm sure we'll do a pretty reasonable job. We'll get straight into it. Before we do, though, Simon, how are you feeling about things? You know, when we last got together a couple of weeks back, we had a pretty frank conversation about the way of the world, and I think our conclusion was it's always a good time to invest in property.
Absolutely.
As long as you're buying the right stuff at the right time. Has anything changed since then? It's still same principles hold firm?
I don't think the negativity will ever go away at any time. That just seems to be what people do these days. But the world's full of positivity. Certainly the lens I look at it. And in the property lens, I actually consider this to be a really, really exciting time to be a property investor, because there's less buyers in most markets, which means there's less competition. And as a professional investor, we can take our time a bit more and get that right property at the right price, sit back and be patient. If we've got the fundamentals right, the growth in future years, we'll get 100% of that. And the DIYs, they often come in mid-cycle and force up the price of the asset that we bought when the market was flat.
That's handy, isn't it?
Love it.
How and I share your positivity and optimism and caution as well.
Yeah.
So go and listen to that chat. But how are the real estates of the world finding us? So a buyer's agent, a property strategist, the game that you're in, your relationships with real estate agents are bread and butter stuff, right? So you're either getting stuff off market before they open up to the world, and therefore you can move quicker and potentially get better assets. On the flip side, when there's a lot more sellers than buyers in the market, you're typically the first port of call for bargains and people who need to shift stuff pretty quickly. So the relationship with the real estate agent is critical. Whether or not real estate agents are chasing buyers agents or buyers agents chasing real estates is a real indicator to me of market cycles.
Yeah.
Are agents your best friend at the moment, or they hate you guys?
Depends which market we're talking about.
Okay.
We're currently now investing in 5 different locations throughout Australia, and that's in 3 different states.
Okay.
One of those at the moment, I think that maybe by the time we get to the end of 2018, that location might be reporting an increase in median dwelling prices of about 15%.
Okay.
It's not showing that now because there's always a lag between what's happening in a market and when the data is actually collected and reported, but it's moving at a fast pace. The cycle's just started. So those real estate agents, they got no worries about selling properties.
Yeah. I won't ask you where it is because you won't tell me.
I won't tell you.
Yeah. Is it metro or regional?
It's regional.
Give me that. Okay.
Regional.
Right. Which state is it?
No, I'm not telling you that.
All right, fair enough. Okay, so their agents are chasing you to
in that market.
Stuff.
No,
yeah.
we're chasing them. We're trying every trick we've got in the kit bag to get them on side so that we can at least get a couple of days heads up that something's about to hit the market before the broader public does. We're having some wins.
Yep, good.
But that's the advantage of being a professional investor. You're buying every day. A DIY's got no chance of that.
Okay.
Other markets though, it's flat, and they're the ones that the real estate agents are calling us saying, this beautiful property. They've always got the best property, of course.
Of course they do. They do. What about Tassie? You still buying down there? I know you've been very vocal about Tassie over the years. We spoke about it last time we got together.
Yeah.
You stopped buying?
Look, I mean, Hobart's still got a long way to go, I think. But we stopped buying there in about mid-2016.
Okay.
But generally speaking, regional Australia is where the fantastic opportunities are for property.
You've always been a big advocate of regional Australia. And a lot of people, I think, and I'll touch on this very quickly because a lot of people confuse regional Australia with mining towns.
Yeah, the stereotype.
Yeah. And when you talk about regional Australia, you're talking about very diverse, economically diverse, large regional centres. You're not talking about a punt in a Moranbah type of situation. That's correct.
Correct. Look, a lot of people say to us that Propertyology is, very pro-region. I don't know that's right. What we are is we're objective to every single market. We've invested in plenty of properties in capital cities and plenty of properties in regional locations. We look at each market on its merit, but there's lots of regional locations that I describe as a mini capital city. So as you said, they've got a diverse economy, lots of different industries. They've got all the essential infrastructure. Yeah. And the thing they've got in spades is affordable housing. And contrary to what a lot of people who might live in a capital city think, a lot of those economies are really picking up, and many of them have a better economy now than several capital cities. But in terms of mining towns, the biggest mining town in the country is Perth, and the second biggest mining town in the country is Brisbane.
True.
You strip coal out of Queensland, you strip iron ore and gas out of Western Australia, and you've got nothing in those capital cities.
Yeah. And in terms of a classification of regional town, would a Newcastle or a Wollongong be regional in your books?
Absolutely, yeah. Technically you can only have one capital city in each state and territory, so we've got 8 of those. Any other location is technically regional. So, Newcastle and Wollongong are arguably our biggest regional cities.
But then you look at, in Melbourne, Shepparton, in Victoria, Shepparton, Ballarat,
Bendigo,
regional towns.
Geelong,
Geelong is regional. So Geelong is essentially the Wollongong of Melbourne.
Yeah, all those
regional towns.
Queensland, it's Gold Coast, Sunshine Coast, an hour either side of the capital city. But then you go all the way up the coastline. Queensland's actually got more genuine regional cities than any other state. It's because it's the most decentralised state.
Okay.
Only 48% of Queensland's population live in Brisbane. There's more people who don't live in the state's capital.
You're always good for a stat.
I love stats. Yeah. I love regional Australia.
Yeah, loves regional Australia. Anyway, let's get to some questions, Simon. First one from Jack. Thanks for this, Jack. Hey, love the show. I'm interested in getting a duplex, and I was wondering if they have a different vacancy rate in comparison to a single dwelling with the same bedroom and bathroom. I imagine that's the numbers. I would also like to know how duplexes perform in capital growth in comparison to that of a single dwelling. I'm going to kick this one off, Simon, with something we spoke about last time we got together, was around the type of property that you purchase. We spoke about pockets of information by memory rather than suburbs, and then the type of property. So what sort of property best suits that particular pocket, and the pocket being what makes it livable. So you look at a character of some suburbs, they're all units. So buying a house in a pocket which is full of units might not be the right thing to do. So this guy's getting really specific, saying, should I buy a duplex or a house? I know you're going to answer, it depends, and how it's going to perform will also depend on where you're buying it and why you're buying it for.
Yeah. Jack, thanks for the question. Before I answer the question, my concern is that you're actually asking the question, because the way the question is worded is Jack's already made his mind up that he wants to buy a duplex, and he just wants us to endorse that decision.
And we spoke about this last time we got together as well.
Yeah, and look, whether it's a house, whether it's an apartment, whether it's a duplex, you need to make that decision at some stage. But before you get to answering that question, you need to first work out which location, which town, which city. That's your first decision. And then you drill down to the pockets. And once you've identified that right pocket, then you start working out what's the most suitable dwelling style for this particular pocket. So this question implies that Jack's just made his mind up for whatever reason, wants to buy a duplex. If that's what you want to do, Jack, go and buy a duplex. But I would ask a question of you. Why do you want to buy an investment property? I don't know anyone I've asked that question to that hasn't said, the reason I want to do that is I'm earning some money now, but I know that I won't always be earning some money. At some stage in the future, my health won't allow me to, or I don't want to work anymore. I'm going to need an income from some source, and they choose property as an asset class. So if the objective is to make money, focus on that rather than making a decision, I just want to buy a duplex.
Completely agree. Good sage counsel. Right, next question. To help you out, Simon, it's the one under that one from Jack. It's from John. It's a little bit longer, this question, so bear with me. John writes, I've been listening to the podcast for almost a year. Thanks so much for the education you and your team have provided. If I hadn't stumbled accidentally onto this podcast, the Australian property market would have been completely flown above my head. I am on a low income, and so is my sister, and we are looking to partner to acquire an investment property later this year, hopefully. We'll be looking for properties in the 350 to 400k range with around 10% deposit. We are okay with LMI. The goal is to enter as fast as possible to stay longer. One of your fundamental arguments is, should we use a buyer's agent or not? We do appreciate the service and the immense knowledge they would bring to the table. And knowing you're a big advocate for buyer's agents, I'm immensely interested in hearing your opinion. Due to the fact that using a buyer's agent, it would mean saving a few more months to pay for their fee, which would mean probably entering the market next year. Thanks for your feedback. Kind regards, John. Good question, John. And my first point would be that it looks like you guys are thinking the right way in terms of understanding your ability to borrow, the type of assets which are available to you, and then also the enabler of what LMI can do for you. So LMI, for those of you who aren't familiar with it, is lender's mortgage insurance. Essentially what it is, if you're borrowing above 80% of the value of a property, essentially it's an insurance policy that you pay for that is taken out the lender should you not pay for the property. It means that they're going to get their money back, essentially. What it means, though, is that it's a fee. If you're around the 350, 400K range, and Simon, you know this better than me, it's probably about $4 or $5 grand.
Probably something like that, yeah.
And you can capitalize that into the loan, meaning that you don't have to pay for it right now. You can actually put it on top of the loan, which means that you pay it off over time along with the principal part of it. So it gets added to the principal of the loan. So you're thinking the right way, John, in terms of if I pay for LMI or if I go at a higher LVR, I can enter the market right now. But if I want to use a buyer's agent and therefore buy a better property, it might slow me down from getting in the market. So I'll summarize this question for you, Simon. Should you use a buyer's agent? You're going to say yes, because that's what you are. But I'm sure, to critique you, there'll be times where you don't need to use a buyer's agent. And doesn't matter right now in this current market, the speed to enter the market. If you don't enter the market today and you do it in 6 months' time because you choose your buyer's agent, is it going to matter, or it's just going to dictate where you buy?
I agree. They seem to be on the right spot. I like the fact that they haven't sort of said, we can't invest now because we don't have a 20% deposit.
Yeah.
The time it could take you to save that extra 10% deposit, who knows what the market might move at. But really this is about, for John or anybody, giving yourself the best chance of making the best decision possible. And key to doing that is having the best information. Property asset, and they're talking $350,000 to $400,000. Even if it was half that, it's still a lot of money.
Yeah.
It's one of the biggest financial decisions that anyone ever makes. I'd suggest more than any other decisions, it's really important to increase your chances of making a really, really good decision. So engaging with a professional doesn't give you a guarantee, but it increases your chances of making a really good decision exponentially. If it wasn't property, if it was medicine, you can save yourself the cost of a doctor's fees and try to self-diagnose on Dr. Google, but I'd suggest your health's really important. You want to get that right. You could lodge your tax return online and not pay an accountant. Your tax return would be lodged, but would it be lodged well? You could have a crack at building a renovation on your home, or you could pay a really good builder, which is going to be the better product at the end of the day. Yeah. All good things in life, I think, come at a cost. It doesn't give you a guarantee. It just increases your chances of doing it better.
And this attitude towards the speed of entering the market and paying MLI as a result of it, that's a real hurdle that a lot of people never get beyond, right? Where they think that, I don't want to pay that fee because it's wasted money, or I could have all the research in the world and spend years and years and years educating myself on property, but never actually go about making that decision. Looks like John's okay about making a decision. He's just unsure which decision to make. So in terms of guidance, what would I say? I'd say, John, you've got to make your own call, mate. Whether or not you want to use a buyer's agent, and you need to affirm yourself what benefit that's going to be. So my advice would be to chat to a number of buyer's agents. I don't know where you're based, and you want it to be quite simple for you to forge a relationship with them. But not all buyer's agents are the same. Not all property strategists are the same. You need to be comfortable with whether or not you want to use them, number one, but which buyer's agent you choose. And you must have people come to see you. So do you call yourselves buyer's agents or property strategists? But or
reluctantly.
Yeah.
We use the term buyer's agent because it's familiar to the broader public.
It's like the currency of what it's called.
Yeah, but the term doesn't accurately describe what we do. I mean, a buyer's agent technically is the reverse of a real estate agent.
Yeah.
They don't sell a property, they help people buy a property, and they're a trained professional to do that.
So there's the bit of just the negotiation, which a buyer's agent, you could say, I want to buy this house here, you go and buy it for me.
That's part of the buyer's agent service.
But the broader appeal where you sit within this whole appreciation, understanding of what people are trying to achieve through property investment and matching an investment strategy with their particular circumstances, the property bit of it is just part of it, right? It's a big dialogue that goes into it. So When people come to you and say, "Oh, Simon, I'm thinking about using you to, help me down this path of property investment," do they often see other buyers agents as well? Is that a common thing, or does someone normally make a decision?
Yeah, I'm sure some do.
Yeah.
Some don't. I mean, I think property is one of those things that heaps and heaps of Australians are really interested in it, but because it's so expensive, it's not something that they do often. What Propertyology see a lot is when, by the time someone inquires about our services for the first time, we've never heard of them before, but the conversation, it's a strange feeling, the conversation from our end, it's like we're talking to a friend, because the thing with the internet these days, they've been following us for years.
Yeah.
We produce a lot of content. They hear us on shows like this. They read our blogs, probably follow us on social media. By the time they first touch base with us, they've already got this high level of confidence. We're still getting to know them. We've just heard of them from the first time. So, but I'm sure that some inquire with others as well, and there's nothing wrong with that. That's good. That's a good way for the consumer to work out who's the right fit.
So what are the three things you need to look for to make sure your buyer's agent is right for you?
Look, if you're an investor, it's really important to seek out a buyer's agent that just does that. Because there's plenty of buyer's agents that will, specialise on helping someone buy a renovator or the family home, or maybe the first home buyer market, and that's all really, really important. Those buyer's agents will do a great job for that segment of the market, but anyone who tries to be a jack of all trades is a master of none. So we will only ever take on an appointment as a buyer's agent to work with an investor. We never take on a family home. So if you're looking to buy a property as an investor, find buyer's agents that's all they do. What we do in addition to that, and I think our biggest asset is our research. So our office is in Brisbane, but our market is all over Australia. So someone who seeks us out as a buyer's agent because they want to tap into all that research. They haven't made their mind up, where I want to invest. They want to engage in our expertise to help make that decision.
So if you go and see a buyer's agent, they try and sell your property on the first time you meet them, are they a buyer's agent?
No, no, they might use that term. But a genuine buyer's agent doesn't have a stock list.
Yeah.
They don't have photos of houses and apartments in their window. That's a sales agent. A genuine buyer's agent will sign a document with you as the buyer, and you are appointing them as your professional, and they pay you. They pay the buyer's agent directly, which is the reverse of the Ray Whites, LJ Hookers of the world, who are paid by the owner of the property to sell it. So the buyer's agent is working 100% in that client's best interests. And
it's a bit grey, that sector. So, John, just be careful who you consider to be a buyer's agent. And I'd probably use Simon's point there. If they try and sell you a property, they're not a buyer's agent.
A quick tip.
Yeah.
Make sure you go to the REBA site.
Okay.
REBAA. So that's the industry body for buyer's agency Australia-wide. They don't allow anyone who just has got a shingle at the front of their office saying, I'm a buyer's agent, to be a member. They scrutinise membership applications closely. The grey area you spoke about there, Phil, and people need to be aware of that. They won't be a member if there's a grey area.
Rich Harvey's the head of that, isn't he? Yeah. Rich won the Real Estate Business Awards Buyer's Agent of the Year recently. So, go and check that out. If you're on the list, they're probably worth having a chat to. All right, let's move on. Next question is from Christy. Again, it's a little bit longer, but I'll read it out to give it some texture. Hi there. I've heard you and other investors talking about monitoring your numbers, LVR, valuation, interest rates, yield, etc. on a spreadsheet. I'm setting one up now that's less tax focused now that we are about to settle on our third property. What I want to know is, when looking at an individual property, do you generally calculate the LVR, yield, etc. based on how much you spent on that property, or do you do it based on what the loan is secured against? For example, say you had a principal place of residence that had a loan of $500K on it. You do a limit increase of $100K for a deposit on another property where the new property loan is $250K at a different bank. The bank will therefore calculate the LVR on the PPR based on a $600,000 loan. However, as an investor, and to get a more accurate view, would you normally calculate the LVR on the PPR at $500K and the new property at $350K? What would you advise? I would like to try and get my metrics consistent with my spreadsheet. Love the show, thanks. Okay, quite detailed there at the back end of that question. So how do you calculate the LVR? How do I do it on my spreadsheet when I look at my portfolio? I actually do it a number of different ways, to be fair. Let's talk about yield, I think is better, but also LVR. You can look at your LVR on what the debt amount is against the value of the property, but what is the value of the property? Is the value of the property what you paid for it? Is the value of property what the property is worth now? Or is the value of the property what you paid for it, plus all the other money you spent in order to secure that property, stamp duty, legals, pest and building inspections, et cetera, et cetera. When I view my portfolio, whether I'm looking at yields or LVRs or whatever, but mainly on the yield side, I look at it as what I spent to actually get that particular property rather than what the price was that I fundamentally paid for it. A lot of people will look at yields, for example, based on what they pay for the property and make it sound a lot better than what it is. But often if you're buying a $400,000 property, you might have another, $40,000 of other stuff associated with it, or you spend a lot of money on renovating at the time of purchase. So I like to be realistic with how I measure the portfolio and as conservative as possible, because I want the real pictures and I don't want to be faking the numbers to myself to make myself feel good. Is that what a good investor should do, Simon?
I think it's whatever the individual is comfortable with. The numbers are for you. It's not like there's a legal requirement for you to complete any spreadsheet. It is prudent, however, to monitor what you've done, to have a record somewhere, and then to monitor how that's tracking. So, and the simplest way to do that is a spreadsheet. You don't have to do it. So put whatever information in there that interests you. If you're a really analytical person like I am, you'll create formulas for all of these scenarios. But it doesn't mean that you have to. The yield is a good one. If you bought a property today, you paid $400,000 for it. It was rented for $400 a week, and you work at the gross yield today. But then in a few years' time, that rent might have increased from 400 to 420. The yield has changed, but do you work, and the value will change as well. So that affects how you calculate the yield. So there is no right or wrong.
There is no right or wrong. But the idea is to actually understand what your true financial position is on the basis of, am I under stress to hold a property or a property portfolio, or have I got some room to play with, and can I sort of ratchet it up a little bit and maybe secure some more properties? That's the purpose of doing this. That's the goal. Putting a spreadsheet together is just a tool to help you get there and actually understand that.
Yeah, I think that one thing you want the spreadsheet for is to monitor your potential to invest again. So understanding your current loan-to-value ratio based on estimated current value of assets and current loan balances, that's important. What isn't mentioned here, but I think is important, is the annual cash flow. Yeah. So yes, the yield is important, but that's just a percentage. A percentage doesn't come out of your wallet. What does actually come out of your wallet, that's important to put that in there.
Before tax.
Yeah.
Yeah. So what is the true cost of holding a property, whether it's positive or negative, and what does that mean at the end of the day?
Yeah.
Because, cash at bank is what the true indicator of the performance of a property or a portfolio. So, but get all the spreadsheet I use is pretty complicated, and it tells me anything at any given time about what I want to know about. And I really err on the side of conservatism. When I look at forecasting yield, I make sure that I take into consideration and I give away 5 or 6% of my income to a property manager.
Yep.
And there's probably a good chance that maybe for a couple of days, couple of weeks of the year, I might not have someone in there. So I factor all that in there. So the number I get is, the worst case number rather than the best case number.
Yep.
Just depends how you're wired. Got time for one more question, Simon. So let's do it. Hey guys, love the podcast. Keep up the good work. Thank you, Hannah from Newcastle. My question is around buying a property that is initially a PPR, principal place of residence, but is turned into an investment property down the track. My partner and I are looking to buy a house that we will live in for a few years, but eventually we planned for it to be an investment. What considerations around mortgage structure, tax, etc. should we think about at the beginning to enable that transition later on? Whose name is best to put on the title? Any tips or advice you guys have would be awesome. Keep up the good work, Hannah. In terms of giving advice around this, I've got to give a recommendation around structure and how to secure this asset with the future in mind is to speak to a pretty good accountant is where I would start, Simon.
Plan with the end in mind, I would say. So you're going to live in it initially, but my understanding of this question is that's not the primary purpose for you buying it. It sounds like you've already made your mind up, you're moving out. So make the decision in terms of the name you buy it in and how you set your loans up as if you were buying it as an investment property for day one, because the cost to change that at a later date, the name on title and refinance loans and all that sort of stuff is going to be a lot of money, a lot of time, and even might not be accepted by the tax office. anyway. We won't give advice on this show, but some considerations for Hannah. Get your head around how powerful an offset facility can be. Fast forward 2 years from now, this loan is going to be 100% tax deductible once you start receiving rental income for it. So it might be wise to, rather than from day one, have a principal and interest structure, which you would for a typical family home. You're probably in the longer term might be more in favour of having an interest-only facility, but you can effectively be paying principal off it by putting the extra money in an offset facility. Separate to the structure, the consideration, why is it that you've made your mind up? If you've already decided that you're not going to be living in Newcastle long term, why are you making a decision today to buy an investment property there? Have you taken the time to understand where Newcastle is in its cycle and its long-term outlook? I'd suggest its growth cycle is behind it.
So what you're saying is that just because you want to buy a house doesn't necessarily mean you should be buying in Newcastle.
Yeah.
There should be, or could be, a better place where your money will work harder for you. And then why don't you just rent property in Newcastle if that's where you want to live?
Hannah sounds like the perfect rent investor for me. She wants to buy a property. The primary motivation is investment.
Yeah.
Okay, Hannah, fantastic. Good that you're taking your financial future seriously, but your market is all over Australia. Your current neighbourhood is Newcastle.
Yeah.
That's where you live. Your market is all over Australia. So a lot of money in your deposit and your stamp duty and legal fees and all that sort of stuff. You owe it to yourself to get that money working as hard as you can. To do that, you've got to understand all markets across Australia.
I agree. It's good.
Great
Goes
question.
back to all the stuff we've been talking about, right?
Great question.
Yeah, it is. And again, a lot of investors go into a particular decision based on this one I'm going to do. I'm going to either prove or disprove it. And, often that might not be the best way to shape the way in which you're going to take action. Keep up the research. Keep looking around. I'd look to, Hannah, expand your mindset around what Simon spoke about. Just because you're Hannah from Newcastle doesn't mean you necessarily need to buy a property in Newcastle. And if you want that to be your home at some point in time, maybe you can put your money working for yourself elsewhere. At a point in time, you can refinance and use the uplift in capital value to get yourself a nice deposit for a nice home in Newcastle that can make your PPR. So lots of different ways you can approach it. But chat to some people and, around tax structure, speak to a good accountant. And there's plenty of other people who could probably give you some sage advice around where you should be investing. That's it for us, Simon. That's all we've got time for today. Really good. Thanks for coming in again.
It's my pleasure.
I know it's not a long way from Brisbane. It's just a plane trip away.
Nothing's too long these days.
You get around a fair bit anyway, right, for work. Just
do a bit of
checking
travel.
out. Yeah, we spoke about meeting mayors and all this sort of stuff. So you do get out there. You, I want to try and get something out of you. But I know you keep your cards pretty close to your chest. Can you give us something? You might not be investing there, but where do you like right now? If you want to invest in a good, regional, affordable town, give us a hint. Anywhere good? Anywhere you like, but you're not investing?
Okay. I'll give you about 10.
Okay.
Right, that are worth people looking at really, really closely, in no particular order.
Yeah.
New South Wales, Orange, Dubbo, Bathurst, Wagga, Tamworth, Armidale, that's lots.
Okay.
Coffs Harbour, there's lots there. Victoria.
All those got a university campus. They've got everything there.
They're mini
Most
capital
of them,
cities.
Yeah.
Mini
Okay.
capital cities. Victoria, again, no particular order. I was going to say Geelong. I really like Geelong, but it's already in the middle of a really strong cycle.
Yep.
So I would say no. If we were having this discussion 3 years ago, I'd say absolutely.
Yep.
Ballarat's already going strong. Probably got some time yet, but I'd say no. I like finding markets that have a good future but haven't started the cycle yet. So then in Victoria, that leaves places like Bendigo, smaller location, but somewhere like Warrnambool. Colac is much smaller, but if you really understand these markets, there's a difference between risk and opportunity.
Okay.
South Australia, really outside of Adelaide, there isn't much in the way of regional locations. Queensland is littered with them, and none of them have really seen any growth for a good decade. I've been very bullish on Cairns for a couple of years and remain so. Townsville's still, if you're just looking at unemployment rates, it's high, but the pipeline for infrastructure projects is quite exciting. So there's an outlook that's quite good there. But right down the coast, Mackay, Rockhampton, Gladstone finally is, I think, hit its bottom.
Okay.
Doesn't mean that people should be rushing in
Yeah.
to buy there now. Toowoomba has lots of potential. Gold Coast and Sunshine Coast have been probably the best performed Queensland markets over the last few years. I personally would avoid Gold Coast. I think a lot of its growth was related to the Commonwealth Games, and that's behind it.
Yeah.
Where have we covered?
WA.
WA. The economy is stabilised, which is good. Been troubled few years there, but places like Albany, Margaret River is actually shown some positive growth, even though Perth's still declining.
Okay.
And Geraldton, they all have different fundamentals, different outlooks. But I've probably rated off 20 locations.
Yeah. And Tassie out of Hobart.
Tassie's obviously a smaller state, but nothing wrong with having a look at Burnie, Devonport, and Launceston. They're the really big regions in Tasmania.
So, out of all those places you mentioned, are you investing in any of them?
There's a couple we are,
Okay, all right, there you go. Well, secret in there somewhere. I don't know where it is. He's not telling me, so I'll even ask him off air, and I know he won't tell me either.
I won't tell you, no.
Fair enough. Thanks, mate. Enjoy it.
My
always.
pleasure.
Remember to check out smartpropertyinvestment.com.au. If you're not subscribing to our morning newsletter, so you're the first to know what's happening in property right across Australia, where you should and probably shouldn't be investing. smartpropertyinvestment.com.au/subscribe. We're on social media as well. Just search Smart Property HQ. You can track us down and you can follow us and you can hear everything that we're up to, including all these podcasts that we do. And that's pretty much it for me today. Any questions at all about what we discussed today or any of the podcasts, we will get around to them. So thank you very much for those of you who have written into us, particularly today, Hannah, Christy, John and Jack. Appreciate you guys getting in contact and keep those questions coming. We love answering them. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.